If you are over the age of 65, the government has quietly opened a door to a potential $6,000 tax break that is currently sitting unclaimed by millions of Americans. It sounds like a scam, but it is actually buried deep within the fine print of the latest tax code adjustments, and if you miss the specific eligibility rules, you will leave that money on the table for good. We are going to break down exactly what this credit is, how the income thresholds work, and why the most common mistakes seniors make are causing them to be rejected by the IRS. First, let's talk about the Taxpayer Advocate Service. They have repeatedly noted that seniors represent one of the largest demographics of underclaimed tax benefits. Many people assume that because they collect Social Security, they don't need to file, or they assume they aren't eligible for certain credits because their income is too low. That is the biggest trap you can fall into. The specific tax break we are focusing on is the credit for the elderly or the disabled. It has been around for a while, but with the recent inflation adjustments and the updated thresholds for the 2024 tax year, the math has changed significantly. Depending on your filing status and your adjusted gross income, this credit can reduce your tax bill dollar for dollar. To qualify, you must be 65 or older by the end of the tax year. That is the easy part. The real challenge is the income limitation. This is where most people get disqualified before they even finish their first form. If you are filing as a single person, your adjusted gross income must be below $17,500. If your income exceeds that, your credit begins to phase out. For a married couple filing jointly where both spouses are 65 or older, the limit is $25,000. Now, listen closely. This is the part that trips people up. That income limit is not just your take-home pay. It includes your non-taxable Social Security benefits, your pensions, and your annuities. The IRS uses a specific formula to calculate your initial base amount. For a single filer, the base amount is $5,000. For a married couple filing jointly, it is $7,500. From that base amount, you must subtract any non-taxable Social Security or other tax-exempt pensions you received during the year. Once you have done that math, if you have a remainder, you multiply it by 15%, that is your credit. When you see the potential for a $6,000 benefit, it usually comes from the combination of this federal credit and state-level senior homestead or property tax circuit breaker credits that act in tandem with your federal status. Many states use your federal AGI to determine your eligibility for property tax relief. If you optimize your federal filing, you trigger a chain reaction of state-level savings that easily pushes your total benefit into the thousands of dollars. Let's look at a concrete example. Suppose you are a single senior with $12,000 in Social Security income and $8,000 in part-time work or retirement account distributions. Your AGI is $20,000, you are slightly over the threshold, and you might think you are ineligible. However, if you contribute to a traditional IRA or certain health savings accounts, you can lower that AGI. By lowering your AGI by just $3,000, you suddenly fall back into the eligibility window. That move doesn't just save you the income tax on those dollars. It unlocks the credit, which then keeps your total tax liability near zero and prevents you from losing state property tax breaks that are income restricted. The biggest mistake is ignoring your Schedule R. Schedule R is the form used to claim the credit for the elderly or the disabled. Most tax software programs don't highlight this form because it is considered niche. If you are using a basic automated tax platform, it will often skip the question entirely. You have to manually search for Schedule R and force the software to calculate it. If you don't do this, you are effectively opting out of money the government has set aside specifically for your age group. Beyond this credit, we need to talk about the standard deduction. If you are over 65, you are entitled to a higher standard deduction than everyone else. For the 2024 tax year, a single filer under 65 gets a standard deduction of $14,600. If you are 65 or older, that jumps by an additional $1,950. If both you and your spouse are 65 or older and filing jointly, that boost is even larger. Why does this matter? Because the higher your standard deduction, the less of your income is taxable. By maximizing your deductions, you lower your AGI. By lowering your AGI, you stay under the thresholds for the credit for the elderly or the disabled. It is a dual-layered strategy that most seniors ignore because they simply sign their taxes without looking at the line items. Let's talk about the hidden danger of IRMA. IRMA stands for Income-Related Monthly Adjustment Amount. This is the surcharge you pay on your Medicare Part B and Part D premiums if your income exceeds certain levels. If you make an extra $5,000 in withdrawals from a retirement account because you didn't manage your tax bracket carefully, you might not just pay income tax on that money, you might trigger an IRS surcharge that costs you hundreds of dollars in monthly Medicare premiums that is effectively a hidden tax. So, how do you fix this? You need to look at your modified adjusted gross income. This is calculated using your AGI plus any tax-exempt interest. If you are close to the IRMA thresholds, which begin at $106,000 for singles or $212,000 for married couples, you should consider delaying certain retirement withdrawals or utilizing a qualified charitable distribution. A qualified charitable distribution, or QCC, is one of the most powerful tools for seniors. If you are 70 and a half or older, you can transfer up to $105,000 directly from your IRA to a qualified charity. This money counts toward your required minimum distribution, but it never shows up as income on your tax return. By using XCC, you keep your AGI artificially low. This keeps you under the limits for the credit for the elderly or the disabled. It keeps you under the IRMA surcharges for Medicare, and it reduces your taxable footprint overall. It is the ultimate tax-efficient strategy for those 70 and older. Now, let's address the elephant in the room: Social Security taxation. Many seniors are shocked to find out that up to 85% of their Social Security benefits can be taxed if their combined income exceeds $34,000 for individuals or $44,000 for couples. Your combined income is your AGI plus non-taxable interest plus half of your Social Security benefits. If you are sitting right on that threshold, a small unnecessary withdrawal from a brokerage account can push you into a bracket where your Social Security becomes taxable. This is where the planning becomes proactive. If you have the ability to choose where your retirement income comes from, say, choosing between a taxable brokerage account, a Roth IRA, or a traditional IRA, you have the power to control your taxable income. Withdrawals from a Roth IRA do not count toward your AGI. Therefore, they do not increase the taxability of your Social Security, they do not count toward your IRMA brackets, and they do not disqualify you from the credit for the elderly or the disabled. If you have a mix of accounts, you should be drawing down your traditional IRAs to the top of a low tax bracket and then using your Roth IRA for any additional cash flow needs. This prevents you from spilling over into higher tax territory and protects your eligibility for these critical senior credits. Another common point of confusion is medical expenses. You can deduct and reimburse medical expenses that exceed 7.5% of your AGI. For many seniors, health costs are the largest expense of the year. If you have significant dental work, hearing aids, long-term care insurance premiums, or even home modifications for accessibility, you need to track these. Even if you don't itemize, many states allow a deduction for medical expenses that is much more generous than the federal 7.5% rule. If you aren't tracking your receipts, you are losing out on a tax deduction that could save you thousands. The IRS also has a specific program for low to moderate income seniors called the Tax Counseling for the Elderly, or TC. This program provides free tax help to individuals who are 60 and older. These volunteers are trained specifically in the complex tax issues facing seniors, including pensions and retirement income. Do not rely on a generic online tax calculator. They do not understand the nuance of your specific life situation. You should be looking for a CPA who specializes in retirement planning. A good CPA will pay for themselves in the first year just by catching these specific credits and avoiding the IRMA surcharges. Many people ask, what if I missed these credits in previous years? You have 3 years to file an amended tax return. If you go back and realize you qualified for the credit for the elderly or the disabled for 2022 or 2023 but didn't claim it, you can file Form 1040X. The IRS will review the claim and issue you a refund for the credit you missed. It is important to remember that tax law is not static. Congress changes the rules every single year. The thresholds for 2024 are different than they were in 2023. You cannot rely on what you did 5 years ago. You have to look at the current year's instructions for Schedule R. When you look at the landscape of your retirement, don't view your tax return as a chore to be finished quickly. View it as a financial plan. Every dollar you save in taxes is a dollar you don't have to withdraw from your savings. That keeps your principal intact longer, which reduces your risk of running out of money in your later years. We are living in an era where the tax code is increasingly used to reward behavior and provide safety nets for specific demographics. If you fail to understand the rules, you are essentially paying a penalty for your lack of attention. Ask yourself, are you managing your taxes for this year, or are you just filing them? The difference between those two approaches is often the difference between struggling to get by and having the financial flexibility to enjoy your retirement. Start today. Go through your last year's tax return, look for Schedule or check your IRS, calculate your combined income for Social Security, see if you are sitting on thousands of dollars in unclaimed benefits. The money is there, the rules are written, the only thing left to do is claim it, because if you don't, the only person losing out is you.